Hi, I'm Julie Hawk of thefexperts.com, and I'm a professional Forex trader and technical analyst who enjoyed a 12-year career working in the dealing rooms of major international banks at the vice president level as a Forex and currency options dealer. I'm also a financial writer, Forex account manager, and the co-author with my husband Jay of 5 books published on the topics of financial markets trading and market analysis that you can purchase at Amazon.com. Anyway, I've been invited by Trendy Pips to share with you in this educational video one of my favorite financial market trading strategies that even a beginner can walk away with and implement as part of their trading plan. This so-called swing trading strategy can be used in any of the financial markets, including the Forex, stock, and commodity markets. So let's get started. Swing trading is a speculative trading strategy commonly used among financial markets traders where a tradable asset is held for between 1 and several days in an effort to profit from price changes or swings. A swing trading position is typically held longer than a day trading position, but shorter than buy and hold investment strategies that follow market trends and can be held for months or years. Swing trading has proven itself popular as a trading strategy among many Forex traders over the years. The Forex market lends itself particularly well to short-term strategies, and so swing trading can suit traders looking to capitalize on moves in that market that last more than one day. Furthermore, profits can be sought by either buying or selling an asset. Many swing traders also use a stop and reverse strategy so that they are either long or short a particular market and rarely square. In practice, swing traders often use a number of different market signals and technical indicators to evaluate the optimal entry and exit points in the market. So it tends to suit those who have more technical analysis background. In addition to taking note of nearby support and resistance chart points, swing traders often employ the momentum signals and indicators popular among technical analysts to generate objective buy and sell recommendations when swing trading. Many traders like to use momentum indicators like the relative strength index, the momentum indicator, and the stochastics oscillator that we'll discuss later to gauge market momentum and suggest likely reversal points. The rest of this video will outline how Forex swing traders typically operate and will compare swing trading to other Forex trading strategies. A swing trader typically looks for price moves of shorter duration than trend traders, but of longer duration than day traders. They will tend to hold a position for 1 to 5 days, although in some cases they might stay in a trade for several weeks. This contrasts notably with the trade duration of a day trader who will generally not hold positions overnight. Kept simple, swing trading can be relatively easier to manage than day trading, but it does require the trader to maintain a disciplined approach with respect to stop losses, especially when positions are being taken overnight. Swing traders also have a somewhat different outlook from trend traders because they will often seek to capitalize on price moves contrary to the major trend. On the other hand, trend traders generally look to identify a trend and establish positions on that side of the market to profit from it. Also, trend traders typically hold their positions for a considerably longer period of time than swing traders do. A trend trader will simply identify the major trend and initiate a position in that direction. A swing trader, on the other hand, will generally identify a trend and watch charts of the market movements as levels of support and resistance become clearly defined. They may also compute momentum indicators to suggest when trend reversals or corrections seem likely and trade accordingly. Traders often find swing trading systems relatively easy to develop. A technical analysis plan based on levels of support and resistance, perhaps combined with a trend indicator to confirm the short-term trend, and a momentum indicator to suggest when the underlying trend is strong and when it is waning, are often all that a trader needs. The way that most swing traders evaluate the market depends on levels of support and resistance commonly found within a major trend. Such traders generally wait for a currency pair to hit resistance or support levels within the major trend. They might then initiate a new position or add to an existing one once confirmation of the price direction has been made. After such confirmation, the trader will attempt to initiate the position supported by the momentum of the market's resumed direction. After the swing trader has established levels of support and resistance, a confirmation by another set of indicators is often required before they initiate a trading position. Typically, the trend indicators might be exponential moving averages, or EMAs, and/or a certain reading criteria for a momentum indicator like the relative strength index, or RSI. Once the direction has been confirmed by their chosen indicators, the trader will then initiate a position. As in all good trading plans, swing traders will place stop-loss orders to control risk in the event they were wrong. They may also place an order to liquidate the position in order to take profits at one or more appropriate levels. Another swing trading strategy might involve trading against the major trend in the short term. Such a trader will watch the currency pair move into either a support or resistance zone in one direction, and they will then take a position that will profit from the currency pair's correction of the initial move. Stops will usually be placed beyond the identified support or resistance zone. In general, the term momentum refers to the tendency of an asset's value or an exchange rate to continue to trend. Momentum indicators typically measure the rate of change in closing values and are often used to detect weaknesses in the trends and likely reversal points. Since the momentum of a market is so important to swing traders, especially when it starts to fade and indicates a probable trend correction or even a reversal, it makes sense to mention some of the most popular momentum indicators that swing traders can place in their trading arsenal. First of all, indicators that assess momentum based on closing price relative to previous closing price include the momentum indicator, the rate of change or ROC indicator, the smoothed rate of change indicator, and my personal favorite, the relative strength index. Indicators that assess movement based on the closing price relative to the range include the stochastic indicator, the slow stochastic indicator, and the Williams %R indicator. Indicators that assess momentum based on the closing price compared to moving average include the commodity channel index and the detrended price oscillator. Indicators that assess momentum based on closing price relative to the high-low include the Williams accumulation distribution indicator. Each of the aforementioned momentum indicators have applications for technical analysts and swing traders, although they do have various pros and cons that need to be mentioned. While a discussion of all of these indicators is beyond the scope of this video, I will compare 4 of the most popular momentum indicators in this section. In my experience, the momentum indicator has 3 main weaknesses. 1, it does not fluctuate between set limits, meaning that overbought and oversold levels have to be reset for each currency pair. 2, movements tend to be erratic. And 3, unusually high or low prices at the start of the indicator window, for example, 14 days ago on a 14-day indicator, can cause distortion. In contrast, the rate of change indicator fluctuates as a percentage around the zero line, but the indicator still suffers from the last 2 weaknesses noted for the momentum indicator. Even better, the relative strength index, or RSI, addresses all 3 weaknesses of the momentum indicator in that it is smoother, not as susceptible to distortion, and fluctuates between 0 and 100. Finally, the stochastic indicator compares the closing price to the price range, which is the high minus the low, for the window period. This is an improvement on the above 3 indicators, which measure relative changes in closing price. Still, the stochastic indicator's movements can be erratic, so many technical analysts use the internally smoothed slow stochastic indicator, which they find more reliable and less erratic. Among the most popular of momentum indicators, the momentum and rate of change, or ROC indicators, are simple technical analysis indicators showing the difference between today's closing price and the close N days ago. Momentum measures the absolute difference in the traded asset's value, while the rate of change indicator scales by the old close and so represents the increase as a percentage, or proportion. The momentum and ROC indicators also show the direction of the underlying trend by remaining positive while an uptrend is sustained, or negative while a downtrend is sustained. For example, a crossing up through 0 may be used as a signal to buy, or a crossing down through 0 used as a signal to sell. How high the indicators get shows how strong the trend is. The way that the momentum indicator shows an absolute change means it might, for example, show a 1 big figure rise in a currency pair over a 20-day period, whereas the rate of change indicator might show that same move as a 0.025 or 2.5% rise over the same time frame. A swing trader can therefore choose between looking at a move in pip terms or in percentage terms. While the 0 crossings are the same for each of these momentum indicators, the highs or lows showing the strength of a trend are computed on a different basis. When using momentum indicators to swing trade, a trader will generally go long when the momentum goes below the oversold level and then rises back above it, or on bullish divergences when the first trough lies below the oversold level. Furthermore, traders will typically short the market when the momentum indicator crosses above the overbought level but then falls back below it, or on a bearish divergence where the first peak lies above the overbought level. In addition, while the best bet when using momentum indicators is usually to take trading signals only in the direction of the trend, some swing traders attempt to profit both from moves in the direction of the underlying trend and from counter-trend market corrections. If an uptrend exists, you can go long if the momentum indicator turns upwards when it lies below zero. Likewise, when there's a downtrend, you can go short if momentum turns downward when it lies above zero. In conclusion, swing trading occupies a rather attractive gray area between day trading and trend trading that can help traders take advantage of the considerable fluctuations often seen in financial markets while still profiting from longer-term trending moves. With a bit of practice, the swing trading strategy could make a good fit for newer traders and seasoned traders alike. Furthermore, the profits earned with a swing trading strategy can exceed those earned by trend traders, since they benefit from both trending and counter-trend moves. In addition, swing trading strategies certainly do not require the amount of focus or intraday activity that day trading or scalping often requires, so trading commissions and dealing spreads matter less. Overall, swing trading definitely merits further study and consideration for those willing to take on holding trading positions overnight and who feel comfortable using technical analysis to determine support and resistance levels and market momentum. This concludes my video presentation on swing trading, and you're invited to like it and share it, as well as to leave your comments and relevant questions below. Also, if you would be interested in watching an educational video on another topic related to financial markets trading or analysis, feel free to just let me know. Thanks for watching, and I wish you good luck.